At 2 o'clock in the morning, America's financial system was collapsing. Banks were running out of cash, depositors were panicking, stock markets were on the verge of shutting down. The United States government searched desperately for a solution. There was none. No central bank, no emergency authority, no institution powerful enough to stop what was coming. And for the first time in modern history, the world's richest democracy handed its survival to a single private banker. Welcome to Fiscal Secrets. On this channel, we uncover the hidden financial moments that quietly shaped the modern world. This is the forgotten story of the night America almost shut down. In 1907, the United States looked powerful on the surface. Factories were booming, railroads stretched across the continent. Wall Street was becoming the center of global finance, but beneath that confidence lay a dangerous weakness. America had no central bank. The money supply was controlled almost entirely by private banks and trust companies, each acting in its own interest. There was no lender of last resort. When confidence disappeared, money disappeared with it. The entire financial system depended on one fragile belief: trust. Trust that banks could meet withdrawals. Trust that credit would remain available. Every dollar in circulation was backed not by a central authority, but by private promises. And when one promise broke, the entire system trembled. This risk was known, but for decades, bankers argued private control of money was safer than government oversight. By autumn 1907, the system was primed for collapse. It only needed a spark. The spark came from a gamble. Two speculators, Augustus Hines and Charles Morse, attempted to corner the United Copper Company stock. Their plan: squeeze short sellers, force prices upward and make millions, but the stock collapsed instead. The scheme unraveled in hours, exposing the deep ties between these men and New York's largest financial institutions. Banks that held their deposits, trust companies that backed their loans. Investors suddenly realized their money was at risk. Confidence evaporated. Depositors began asking one question: if these men were wrong about copper, what else could go wrong? By the end of the day, withdrawals had begun. Fear spread faster than facts. What started as a failed stock manipulation was now a threat to the entire financial system. By late October, the panic had reached the banks. Depositors lined up outside trust companies, praying their savings were safe. One by one, trust companies froze withdrawals. The Knickerbocker Trust Company, New York's third largest trust, became the epicenter. Other banks followed. The stock market plunged, businesses paused, loans dried up, transactions that depended on trust ground to a halt. The financial system was teetering on the edge of collapse. One failed scheme had become a threat to the nation. Who could possibly stop it? The answer was John Pierpont Morgan. Morgan was not elected. He held no public office. Yet in 1907 he wielded more influence over the American economy than any politician. Bankers, brokers, and government officials turned to him for guidance. Morgan had the trust others had lost. Trust that he would not fail. Trust that his decisions could stabilize the market. Trust that he would act decisively. He called a meeting of New York's leading bankers in his private library. No government orders, no laws, only one question: could they stop the collapse? Morgan knew a delay could mean ruin, and so he acted. Morgan's solution was dramatic. He locked the doors of his private library. Inside, the most powerful bankers debated, argued, and calculated. Every decision could either stabilize the system or accelerate its collapse. Morgan dictated the terms. Emergency funds would be pooled, loans extended, and stock markets supported. It was an unprecedented concentration of financial power, one man's judgment directing the fate of a nation. By the time the doors opened, an agreement had been reached. Banks had liquidity. Trust would return. The United States had survived the night, not because of institutions or law, but because one man had the courage and influence to act decisively. Once the agreement was made, the real work began. Banks on the verge of collapse received emergency cash. Stocks were stabilized. The panic did not vanish instantly, but the immediate threat was neutralized. Morgan personally oversaw the distribution of funds, leveraging every connection he had built over decades. Private bankers had saved the nation when the government could not. Depositors returned, reassured their money was safe, at least for now. By the following week, the crisis had passed. The United States had survived not because of a system built to protect it, but because of one man's wealth and judgment. The panic ended, but the questions remained. Was it right for one man to hold the fate of a nation in his hands? Morgan had acted decisively, but democracy had no role in this rescue. Banks, businesses, and citizens survived, yet the precedent was troubling. The system had proved fragile. A single failure could have caused widespread devastation. The crisis exposed not just the vulnerability of banks, but the danger of concentrated power without accountability or oversight. Morgan preserved the nation, but he reminded the world that financial stability often depended less on systems and more on individuals. The 1907 panic ended, but its consequences reshaped the American financial system forever. Congress realized that relying on a single banker was untenable. The solution: a central bank that could act as a lender of last resort, independent yet capable of stabilizing the economy. By 1913, the Federal Reserve System was created, a direct response to the crisis Morgan had managed. The nation had discovered that money and trust were inseparable, and private power could sometimes eclipse public authority. Morgan's legacy was cemented. He had not only saved the nation but demonstrated the influence a single financier could wield over an entire economy. For better or worse, the United States' financial future was never again the same. In 1907, America survived the night not because of law or planning, but because one man, J.P. Morgan, said yes. He acted while the government hesitated, while panic spread, and while millions of lives hung in the balance. The crisis ended. Banks reopened, confidence returned. But the question remains, what happens the next time the nation faces a crisis, and no one answers the door? History whispers a warning. Financial systems may rise and fall, but trust and the people who hold it can decide the fate of a country. If you found this hidden story of America's financial brink compelling, hit the bell for new videos, because the next hidden crisis may already be closer than you think.